Good evening. Tonight we are examining a developing story at the intersection of precious metals markets, artificial intelligence infrastructure, and shifting industrial demand, a convergence of forces that, according to one market analysis circulating this weekend, may have significant implications for the price of physical silver in the weeks and months ahead. Curious. On Friday, March 14, 2026, silver futures experienced a sharp decline in the final 90 minutes of the trading session, with the paper price settling at approximately $81.34 per ounce. While mainstream financial media attributed the move to broader commodity sector weakness and rotation into technology equities, a separate line of analysis is gaining attention, one that frames Friday's price action not as a straightforward market correction, but as something far more deliberate and structurally significant. At the center of this story is Project Stargate, a $500 billion technology initiative backed by the United States government and the private sector, described as the largest technology build-out in modern history. The program is designed to construct a supercomputing ecosystem capable of supporting next-generation artificial intelligence operations at a national scale. According to the analysis under review, the United States government has formally reclassified artificial intelligence data centers as critical national security infrastructure, elevating the program from a commercial technology story to a matter of national defense priority. What connects Project Stargate to Friday's silver sell-off? And what role does physical silver play in the future of AI computing infrastructure? Those are the central questions driving tonight's report. To understand why physical silver is being discussed as a strategic material in the context of AI development, it is necessary to understand how artificial intelligence systems actually operate at the hardware level. Artificial intelligence does not run on software alone. It runs on physical hardware, specifically graphics processing units, or GPUs, which were originally designed to render video game graphics, but are now being deployed in server racks the size of shipping containers, running complex matrix calculations continuously, around the clock, 7 days a week. These facilities consume electricity at a scale sufficient to power a small city, and in doing so, they generate extreme levels of industrial heat. The core physics problem at the heart of AI data center design is thermal management. When electrical current is pushed through a conductor at high intensity for extended durations, the conductor heats up. This is a basic principle of thermodynamics known as Joule heating, also referred to as resistive loss. Electrons moving through the atomic structure of the conductor transfer kinetic energy to that structure, causing it to vibrate and raise in temperature. If the conductor cannot dissipate that heat at a sufficient rate, it begins to oxidize, degrade, and ultimately fail. This is where the material properties of silver become directly relevant. Copper, the metal that several Wall Street analysts have suggested could substitute for silver in technology supply chains, carries a thermal conductivity rating of approximately 398 watts per meter Kelvin. Silver, by contrast, carries a thermal conductivity rating of 429 watts per meter Kelvin, the highest thermal conductivity of any element on the periodic table, with no known exceptions and no available substitutes that match it. According to the analysis under review, that 11% difference in thermal conductivity is not a marginal engineering consideration. It is described as the difference between a data center that operates reliably over a decade-long lifespan and one that faces catastrophic failure within 18 months of operation. For institutions committing hundreds of billions of dollars to AI infrastructure, that distinction carries enormous financial and operational weight. Beyond thermal conductivity, the case for silver extends into the domain of electrical conductivity and signal integrity. Modern semiconductor manufacturing now produces chips with transistor gates measured in single-digit nanometers. Signals travel through these systems at gigahertz frequencies. In three-dimensional chip architectures where dies are stacked and every micron of physical spacing is engineered with precision, any degradation in signal quality or any increase in electrical resistance carries measurable consequences for system performance and reliability. Copper, while an effective conductor under standard conditions, is susceptible to oxidation. When exposed to oxygen and moisture, copper forms a surface layer that gradually degrades the quality of its electrical connections, particularly under the thermal cycling that is inherent to high-performance computing environments. Silver, according to the same analysis, does not exhibit the same oxidation behavior under the operating conditions of a high-performance AI server rack. It maintains its conductivity under extreme thermal and electrical stress, and is described as chemically stable in those environments. The analysis further notes that this understanding of silver's material advantages is not new to the engineering and defense communities. NASA utilized silver-zinc batteries on Apollo missions because of the metal's capacity to perform reliably under the extreme thermal conditions of spaceflight. The defense industry adopted silver-plated connectors in radar systems and missile guidance computers beginning in the 1970s. The telecommunications boom of the 1990s required silver-coated switches and relays in systems designed to maintain the highest levels of operational uptime. In each of those historical applications, silver was selected not for its monetary value, but for its physical properties. Properties that, according to this analysis, are now being called upon once again as the United States and other major economies invest at unprecedented scale in artificial intelligence computing infrastructure. Turning now to the supply and demand fundamentals that form the quantitative backbone of this analysis, the figures, when examined closely, present a picture that diverges sharply from the narrative currently circulating in mainstream financial media. Global silver mine production in 2026 is running at approximately 820 million ounces per year. On its surface, that figure may appear substantial. However, when measured against current consumption data, the picture changes considerably. Industrial demand alone, encompassing the technology sector, solar energy manufacturing, electric vehicle production, and artificial intelligence infrastructure, is consuming in excess of 600 million ounces annually. That figure represents industrial consumption only and does not account for investment demand, jewelry manufacturing, or coin and bullion markets, all of which draw from the same finite annual production base. The gap between what is being mined and what is being consumed industrially is currently being filled by above-ground inventory, recycled scrap metal, and liquidation from exchange-traded funds and private storage vaults. The analysis under review is explicit in noting that these supplementary sources are finite in nature and cannot be expanded on demand. They represent a drawdown of existing stockpiles rather than new supply entering the market. Perhaps the most striking supply figure in tonight's analysis concerns the COMEX registered inventory, the physical silver that is formally available for delivery against futures contracts on the commodities exchange. That figure currently stands at approximately 38 million ounces. To place that number in operational context, the analysis presents the following scenario. If a single major technology company determined that it needed to secure a 5-year physical silver supply for its artificial intelligence infrastructure build-out and entered the market seeking 10 million ounces of physical metal, not paper contracts, not exchange-traded fund shares, but actual refined silver bars delivered to a physical facility, that single transaction would drain approximately 1/4 of the entire visible COMEX registered inventory. The analysis describes this scenario not as a hypothetical future possibility, but as a dynamic that is, according to industry contacts cited in the report, already underway. Sources described as working within smelting operations and large physical metals brokerage are reportedly indicating that demand for physical silver at the wholesale level is running at an unusually elevated pace. Premiums charged over the spot price are described as expanding. Delivery wait times, which under normal market conditions are measured in days or weeks, are reportedly stretching into months. Order minimums at dealers are being raised. The analysis also draws attention to developments in Asian markets, specifically referencing the premium spread between London paper prices and Chinese physical silver prices on the Shanghai Gold Exchange. That spread is described as widening, with the characterization that Chinese institutional and government buyers viewed Friday's paper price decline to $81 per ounce as a purchasing opportunity rather than a signal of weakness in the underlying metal. This brings the analysis to what it describes as the broader geopolitical dimension of the silver market in March 2026. Beyond the technology sector's demand, a second category of institutional buyer is identified: the coalition of nations operating under the BRICS framework, which includes Brazil, Russia, India, China, South Africa, and an expanding group of resource-rich countries actively working to reduce dependence on the US dollar and develop alternative trade settlement mechanisms backed by hard assets rather than sovereign debt instruments. The analysis identifies silver alongside gold as a metal with both monetary history and industrial utility that remains accessible enough in price terms for central banks to accumulate in meaningful quantity. The current gold-to-silver ratio is cited in the analysis at approximately 90-1, a level described as historically anomalous and attributed to decades of price suppression through leveraged paper market instruments. The argument presented is that if silver were to be incorporated into any future trade settlement framework by BRICS-aligned nations, or if the paper market mechanisms that currently anchor the spot price were to lose credibility, the ratio between gold and silver prices would compress significantly, implying a substantial revaluation of physical silver. A historical parallel is drawn to the events of 1971 when the United States ended dollar convertibility to gold. At that time, gold was priced at $35 per ounce. Within a decade, the price reached $800 per ounce, a revaluation of approximately 23 times. The analysis presents this episode as a structural precedent for what it argues could occur with silver, with the distinction that the current demand catalyst is not purely monetary, but is reinforced by structural industrial consumption across the technology, defense, and energy sectors simultaneously. The analysis further addresses the position of the United States federal government within this dynamic. With the national debt currently at approximately $35 trillion, growing at a pace described as $1 trillion every 100 days, and with annual interest payments on that debt having crossed $1.2 trillion, exceeding both the defense budget and Medicare spending, the financial architecture underpinning Project Stargate's $500 billion commitment is described as dependent on continued debt issuance and ultimately monetary expansion by the Federal Reserve. The argument presented is that this trajectory implies currency debasement, which in turn increases the real value of hard assets, including physical silver relative to dollar-denominated paper instruments. The synthesis offered is that the United States government faces a structural dilemma, either managing price inflation or securing the physical commodities necessary to win what is characterized as a technological competition with China and other major economic powers. The analysis contends that the announcement of Project Stargate represents a revealed preference, that the government has chosen to prioritize technological infrastructure security over price stability, and that this choice will ultimately translate into sustained upward pressure on the price of physical silver regardless of what paper market instruments reflect in the short term. As we bring this report to a close, let us draw together the central threads of what has been presented. The Friday session on March 14, 2026 saw silver futures fall sharply in the final 90 minutes of trading, settling at $81.34 per ounce. The mainstream financial media framing of that move centered on commodity sector weakness, base metal oversupply, and a rotation back into technology equities. The alternative analysis examined in tonight's report characterizes that explanation as incomplete and argues that the price action is better understood in the context of institutional accumulation ahead of a structural supply shortage driven by artificial intelligence infrastructure demand. Project Stargate, the $500 billion technology initiative backed by the United States government and the private sector, has been formally associated with the reclassification of artificial intelligence data centers as critical national security infrastructure. The scale of the computing build-out described under that program and the thermal and electrical engineering requirements of the GPU-based server architecture that powers it places physical silver, with its unmatched thermal conductivity of 429 watts per meter, Kelvin, and its superior resistance to oxidation under extreme operating conditions, at the center of the industrial supply chain required to execute that build-out reliably and at scale. The supply picture underscores the tightness of the physical market, with annual mine production running at approximately 820 million ounces and industrial demand alone consuming over 600 million ounces. The buffer between supply and consumption is narrow and is being maintained by drawdowns of finite above-ground inventory. The COMEX registered silver available for physical delivery stands at approximately 38 million ounces, a figure that, as the analysis illustrates, could be materially impacted by a single large institutional purchase of physical metal. Reports from industry contacts cited in the analysis describe expanding premiums over spot prices, lengthening delivery timelines, and rising order minimums at the dealer level as early indicators of physical market stress. Layered onto the technology demand story is the geopolitical dimension. The BRICS coalition of nations, described as actively working to reduce dollar dependence and build trade settlement systems backed by hard assets, is identified as a second major category of potential silver accumulator. The current gold-to-silver ratio of approximately 90:1 is characterized as historically anomalous, and the analysis presents the case that any meaningful shift in the monetary status of silver within alternative trade frameworks could trigger a significant repricing of the metal relative to its current paper market valuation. The macroeconomic backdrop completing this picture is one of substantial and growing United States federal debt, with annual interest payments exceeding $1.2 trillion and a projected deficit of $2 trillion in 2026. The financing of Project Stargate and associated infrastructure commitments within that fiscal environment is described as dependent on continued monetary expansion, a dynamic, the analysis argues, is structurally supportive of hard asset values over time as the purchasing power of dollar-denominated instruments comes under pressure. It is important to note, as this broadcast is maintained throughout, that the analysis presented tonight originates from a single source and contains projections, market characterizations, and supply chain assessments that have not been independently verified by this program. Viewers and readers are encouraged to conduct their own research, consult qualified financial and investment professionals, and evaluate the claims presented here against the full range of available market data and expert opinion. This report does not constitute financial advice, and the figures, forecasts, and characterizations cited are those of the original source analysis and not the editorial position of this broadcast. What is not in dispute is that the convergence of large-scale artificial intelligence infrastructure investment, tightening industrial silver demand, historically low COMEX registered inventory, and shifting geopolitical monetary dynamics represents a set of market conditions that warrants serious attention from anyone with exposure to precious metals markets, whether as an investor, an industrial buyer, a policy observer, or simply a citizen seeking to understand the economic forces shaping the months ahead. As Asian markets continue their Sunday evening session and institutional traders begin positioning for the week opening Monday, March 16, 2026, the silver market enters the new trading week against a backdrop that is, by any measure, more complex and more consequential than the Friday afternoon headlines suggested. The full picture, as always, requires looking beyond the closing price on a screen and understanding the industrial, geopolitical, and monetary forces that determine where that number is ultimately headed. That is our report for tonight. We will continue monitoring developments in the silver market, the progress of Project Stargate, and the broader AI infrastructure build-out as this story develops. For this broadcast, thank you for watching. Stay informed, stay engaged, and we will see you at the next update.